Hey everyone, happy Thursday, June 4th. It's about 11:30 in the morning on the West Coast, and it's time for another market update. Well, believe it or not, the war is still going on and still not clear what's going to happen next. Like we've talked about, the markets are very, 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 very focused on what's happening with Iran. Every day something comes out, whether it's that there's going to be peace or no peace, and then that seems to have a big effect on the markets. And it would be very nice if the markets, whether that would be the stock market or the mortgage bond market that affects mortgage rates, or the oil market or whatever, just waited a second until something happened before they overreacted. But I understand that's a lot to ask in this day and age, with information available right away, and people trying to beat each other to the punch, so to speak. So still the main focus. I feel like it's deja vu. I feel like that's all I've said basically since the war started. But it's true because since it does take place in the Middle East, and that has such an effect on oil prices and gas prices and things like that, the markets are super focused on that because that's going to have an effect on inflation and so forth going forward. So no clear. I think this morning there was some talk about possibly a peace deal or some a pathway. So the markets popped for a second, but now they're backing off. So probably again a little bit ahead of themselves. It's jobs week. So normally with no war going on, this would be very important. We're getting all our big job reports for the months. So the first one we got was the April JOLTS report. So that's job openings. So basically, how many job openings are there across the country right now? And that came in at 7.6 million available jobs openings. It was expected to be only about 6.9 million. Last month it was, I think, like 6.88 million. So quite a big jump in 1 month. And again, that was for the month of April. That's a little bit more dated. Also in that report, however, it was the quits rate dropped, I think, from 2% to 1.9%. So how often people are quitting their jobs. Generally, people quit their jobs more often when they feel like they have a good chance of getting a higher paying job. So that's dropped, I think, to the lowest level since 2014. And then also the hiring rate is really low. The hiring rate's down to 3.2%, which shows that there's a bunch of job openings out there, but they're also these companies aren't hiring very many people. So it was like, the JOLTS report was actually pretty good for what we would like to see. We want the job market to show some weakness, so that way the Fed ends up cutting the Fed rates, and that trickles down to mortgage rates, and we get better mortgage rates and more activity in real estate. But the next one we got was the May ADP employment report, and this actually came in a little bit higher than expected. Came in at 122,000, and as you can see, looking at that graph right there, it's heading in the wrong direction as far as what we want. Like we've talked about, I don't want to say I don't want people to get jobs, but again, if the economy seems to be going well on paper, if the job market's going strong, then there's less chance than that the Fed would cut their rate. But if the job market looks weak, then usually the Fed and our economy starts to weaken, which could happen. Then the Fed will cut their rate to stimulate the economy, and that's kind of what we want. So anything that makes the job market look too strong is not something we want. And this looked pretty strong. It keeps going up from that low in January. 122,000, about 115,000 was the expectation. But again, it seems like the labor market is off the lows it was at just going back to January. So have to keep an eye on that. But again, the markets are pretty preoccupied with what's going on with Iran. And we'll talk about in a little bit. The BLS jobs report comes up tomorrow. Consumer issues. So the stats on consumers in America, our consumers, don't look good. The delinquencies are up. And savings rate is down. So basically, delinquencies right now on credit cards are at 13.1%, which is the highest, I believe, since 2011. So that's quite a bit of time. Anything pre-pandemic, you got to take with a grain of salt because things are a little different now. But again, that's a pretty big, serious delinquency rate too, which I believe is over 90 days. Student loans are up to 10.3%, which I believe is the highest since 2020. And then auto loans is at the highest on record. It's at 5.6%. It's not shocking if you see some of these, again, being a mortgage guy, I see some people's credit reports. If you see how high people's, auto loans are, auto payments are a month, it's pretty shocking. So it's not crazy to think that, people are falling behind on these really high payments on these auto loans. So all those things together don't paint the rosiest picture for our economy. If people are falling, pretty far behind, and we're not saving money, the savings rate's down to 2.6%, which I believe is, touching upon lows going back to 2008. that is not a good sign for our economy. If people can't save money and can't pay their bills, then it doesn't look like we're doing too good. So that would be something to keep an eye on. Obviously, we don't want to go into a major recession, but a little bit of a recession, anything that would get the Fed to open their eyes and cut their high rate would be something that would be end up being positive for mortgage rates and probably for the country. Next thing, so we got Fannie Mae home price survey. So basically, this is Fannie Mae and Pulsenomics do this home price expectation survey. So this is appreciation. So what they're saying is in the next year, on a $500,000 house, you should expect to get about 2.5% of appreciation of your home price going up. So that would be a gain of 12,500. So your house in 1 year, on average or median across the country, would be 512,500. In 5 years, cumulative over that 5 year period, they think your home price on a $500,000 house will go up by 14% on median across the country, and that would equate to $70,000 of gains. So again, that's about normal. 2 to 3% is pretty normal if you go back throughout home price history, basically, and take out the pandemic where things popped because people were moving and home prices jumped so much. 7, 8, 9, 10%, stuff like that, where more on average is a 2 to 3% gain. So still looks like being a homeowner is a good thing. Again, you're going to gain equity. It's going to be, gain you wealth in the long term. So just something to keep in mind, even with higher rates, get in there now, a year from now, you gain 12,500 on a $500,000 house, where if you wait a year from now because you wanted rates to come down, then you're paying 512,500 for that house instead of 500. So just something to keep in mind. Next thing, so where does that leave us? The average 30-year conventional rate is at 6.58%. Last week we were at 6.59%. So again, really not a lot of movement. It kind of moves up, moves down, depending on what you hear coming out of that situation with Iran. But things are definitely elevated, higher than we'd like to. So first thing to breach would be the 6.5%, and then work our way back down towards that 6%, which we had got into right before this situation with Iran started. I think end of February. So we're past the what are we to? So past the 3 month mark now. And then upcoming stuff. So like I said, tomorrow we get the BLS jobs report. We'll have to see what happens. The markets have been kind of taking that with a grain of salt just because there has been so many weird things coming out of the BLS. And again, it's one of those situations where what's going on tomorrow with peace talks is going to probably overshadow that. If unless it's something crazy, if unemployment drops a bunch or it goes up a bunch, something like that. But overall, in normal times, it'd be something very important. It's been something that hasn't really helped us, but more than likely, it's kind of probably going to have a muted effect, just basically what's going on in the world. And then next week we get CPI, and then the Fed meets again on June 17th. That's when they would be making their next rate determination. I think right now it's 99% chance the markets are saying that the rate will stay where it's at. They're not going to cut it. They're not going to raise it. Better chance probably them raising it at this point with what's been going on with inflation than cutting it. But again, that can change pretty quick based on what happens in the world and what we know happens in the data. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, I hope you guys have a great rest of your week. Thanks, guys.